So we have two different revenue sources in here. So based on the current assumptions, if we are charging like £6, then we can expect to break even by year two. Now let's change this to dollars. I think dollars is much better. You can change the currency to anything you want in from here. So the purpose of this tool is to create financial models without having any knowledge on how to create a income statement, balance sheet, or cash flow statement. So this is how it works. There are three or four different input segments where you can just change the prices and other stuff, and you can find out if the business is going to be profitable by year two or three. What's going to be the income statement? For example, this is the income statement. Here's the income statement. As you can see, during the first year you're going to be unprofitable. Then we have the cash flow statement, the balance sheet, and everything. So everything is managed automatically in the backend. For example, in the balance sheet, as you can see, we have 715 480 715 480. Everything is balanced in here. Now let's make some change in the input field. Let's say we are going to charge, let's say, $4. So if we charge $4, then let's see what happens. Let's go to the balance sheet again, and if we visit the balance sheet, 295 295, as you can see, it's going towards negative. Everything is balanced automatically. You don't have to deal with Excel formulas, or trying to go through a learning curve on how to build a balance sheet, that sort of stuff. Everything apart from your assumptions is taken care of. Even the assumptions, many of the assumptions are taken care by the AI. So let's say you can't you are facing a mental block, and while starting the business you don't know what sort of revenue sources you should have. So you can just click on AI suggest, and it's gonna give you a bunch of suggestions. For example, commercial laundry pickup, laundry folding. Now let's touch this one by one. So let me first discuss revenue and costs in more details, so that you get a better idea of how this works. So each revenue source has three input fields. The first one is price, the second one involves purchases per year, and the third one is adoption percentage. I don't have to explain price. Now purchases per year involves, let's say you are running a laundromat, and you have let's say 50 customers. On an average, this means that each of the customers are gonna purchase 100 times in a year from you, or avail your services 100 times per year. Avail your laundromat services 100 times per year. That's how it works. On an average, each customer takes your services 100 times. So now what's adoption percentage? Now out of the 20 customers, what percentage of them takes this service? Because let's say you have three different products. Every product will not be used by everyone. So let's say 20% might be using the drying facility, 20% might be using the folding facility, 100% might be using the self service laundry facility. So based on that, we have this adoption percentage. So for this purpose, we are assuming that 100% of your customers are going to avail the self service laundry facility. That's why it's 100%. Now drop off and pick up laundry service, so let's say 20% of them avail this, and 40 they avail this 40 times per year, and you charge $25 for that service. So based on all these factors, your break-even year is 2. Now there's another factor in here, that's direct costs. In here, for each revenue source you have certain direct costs. Direct costs are those that are only incurred when you are selling something, or only when you are generating revenue. For example, if you are offering self-service laundry, when somebody comes to your laundromat, then they will be using your detergents, they will be using your fabric softeners and other stuff, utilities. So these costs are incurred only when you are able to generate some revenue, not when you are not generating revenue. For example, if you have a manager for the laundromat and you have to pay them salaries, then that salary is incurred irrespective of whether you are generating revenue or not. It doesn't matter, you will incur the salaries expense. So that's the key difference between direct costs and indirect costs. Direct costs are also known as cost of goods sold or cost of services, and indirect costs are also known as operating expenses. Now you don't have to learn this, that's not necessary. I'm just explaining for better understanding. You can just um, treat this as a gaming tool and just enter different numbers in here and just find out what happens to the business. This is just a idea mapping tool. If you have a business idea, this tool is going to help you map your entire idea for the next 4 or 5 years. If you could also do this using Excel, but you would need like 3 to 4 years, at least 3 to 4 years of financial training in order to understand everything, understand the financial mechanisms that are going on in the back end of this. Now, one of the questions that might come to your mind is, how do I export this to PDF or Excel? So you just need to click on PDF or Excel in here, and it's gonna look something like this. It's gonna look something like this. For example, this is the Excel export of the income statement. So we have customers acquired, number of customers acquired, income statement, cash flow, balance sheet, and loan repayment. You can also export in PDF, and the PDF is going to look something like this. If you want to make any changes, if you want to modify this further, you can do so in the cs in the Excel file, and just download the PDF from here as well. So it totally depends on you. Now let's move a little deeper into understanding how the whole thing works. So there are three different input fields. The first one is growth and marketing. The second one is revenue and direct costs. Then we have operating expenses and capex. So when you start a business, it depends on three key factors. The first one is how much you are going to invest. Then what are you going to invest on? That is covered in this section. So if you are starting a laundromat, then how many machines you need to buy, what's going to be the lifespan of those machines, because depending on that lifespan we have to calculate the depreciation. Then what's going to be the cost of those machines, when you are going to buy those machines. For example, in here, as you can see, uh, the AI is able to analyze that based on the current projections, based on the current projection of revenue, you would need these machines. For example, the first machine is going to be bought in year one, then some additional machines are going to be bought on year four when your revenue increases significantly. So let's go to income statement. This is year one revenue and this is year fourth revenue. So when your revenue increases, obviously you need to build up more capacity, and the this particular tool is able to do this, automate, adjust the whole thing automatically without any manual intervention. On In addition to this, we have to deal with the funding issue. For example, in this case, we have assumed that we are going to be injecting 500 roughly $500,000 of exactly $500,000 of equity and $300,000 of debt. Now that debt comes with an interest rate and a payback period. Everything is considered in here. Also, we have taxes in here, taxes as well. So let's go back to the income statement for a bit. So since during the first year we are going to be incurring losses, so our taxes are zero. So as you can see, we can adjust everything. So this is the details of capex and investment section. Now let's move on to revenue section. So in revenue section, I already mentioned that we have three different input fields along with direct costs. So you can add as many revenue sources as you want, and those will be reflected clearly in the income statement. Let's go to the income statement. So as you can see, more revenue sources will be as many revenue, all the revenue sources are going to be added in the income statement like this. Then we also have the direct costs from the revenue sources and the operating expenses underneath. Now, one very important factor is, how do I get the customers? So how does customer acquisition fit into the model? That's a very important question. So to understand that, you have to visit the growth and marketing tab. So in growth and marketing tab, first you have to decide what is going to be your launch year. For example, if you are starting a laundromat, you might assume that we won't be able to generate revenue during the first year because we need time to set up the machines, we need to hire people to get everything started. So you might think that we need to start from year two. So based on that, you can just change the launch year. So what happens when you change the launch year? So when you change the launch year, if you go to financial statement and go to income statement, so once you change the launch year from year one to year two, then you have zero revenue during year one, but you have to incur the operating expenses. You can also make the operating expenses zero. That's up to you. So as you can see, we have zero revenue from year one, but we are incurring operating expenses based on these assumptions. So if you want to make operating expenses zero for as well, then you can just turn this into zero, and it's gonna change everything. All the operating expenses, you can just turn them zero. For this assumption, let's keep it as it is. Then so what happens is, let's say you want to acquire customers. So during the initial year, let's say you have 40 friends and family members trying to buy your services, or you have convinced 40 friends and family members to use your laundromat. So let's say 40 friends and family members, organic, and over the years you assume that you will get 10 organic customers every year. So what is organic and what is inorganic? So organic customers are those customers for whom you don't have to spend a penny on promotional budget. They are your friends and family members. But inorganic customers are those on whom you have to spend on marketing budget. For example, uh, this is the marketing budget section, where I have assumed that local advertising I'll be spending 50% and 50% on digital marketing, and this money is going to come from the 50% of year one's promotional, 50%, 15% of the first year's budget. So this 15% is from the initial investment that you are making in the business, the equity injection plus the debt injection. So that's where this comes from. And over the years you assume that over the years it's going to be 5% of the cash balance. So what's the cash balance? So let's say during the second year, this is 2026 and 27. So in 2026 you are going to get the promotional budget from the fund injection of debt and equity. From the second year onwards, you are going to get this budget from last year's from the last year's ending cash balance. So let's say you are starting 2027, so during January you are going to get, let's say you have, in here we have negative cash balance, but let's, for the sake of argument, let's change this. Let's just make it profitable. To make it profitable, we need to change some of the stuff in here. Yes. So let's say, for the sake of argument, that your cash balance during first year is 573,000. So for the second year's promotional budget, let's say you are in January 2027. So during January, you are going to get the promotional budget from, let's say, 5% of this amount. So on and so forth, you are going to get the 2028 budget from 2027's budget, and 2029's budget from 2028's budget. That's how the whole thing works. So this is how we are going to acquire these customers, and the details of customer acquisition is in this particular section. In this particular section, customers acquired and retained. There is also another factor in here, that is churn rate. So if I go to this, so if I have like 2% churn rate, then obviously it's better for my profitability, versus let's say 15% churn rate. As you can see, it becomes negative. So churn rate is basically, everything is already mentioned in here, the percentage of customers that we are going to be losing every year. So if our churn rate is higher, then we're going to be losing more customers. Our average customer acquisition cost is going to go up, which is going to impact our profitability negatively. So let's reduce this to 5%. As you can see, everything changes in here, as I mentioned. Then we have operating expenses. Operating expenses is pretty straightforward. You can just change the numbers in here. These are fixed costs, so they totally depend on your assumption. If you want to add more, these expenses were added by the AI when I generated the model. But if you want to add more expenses, you can just do so in here. You can add or delete expenses at your will. Then we have capex and investment that I already discussed. So that's how the entire input section and assumption sections work. Now let's get back to the financial statements. In the financial statements, the first graph that you are going to be seeing is, when will the laundromat reach profitability? As you can see, based on this, it's going to be sometime in during the second year. Then we have the capex per year. So based on this section, when will I invest, what's going to be the capex per year for the next 5 years? This will obviously change based on your assumptions. Then we have the cash flow, the gross margins, net margins, the revenue per revenue source, section. For example, the dominant sources in here are self-service and drop-off. Since the other services are not significant, so the graph is it's not being represented in the graph in here. Then we have the customers retained and everything. So every for each year, let's say I acquire certain customers and some of them leave us. After that, we are left with the remaining number of customers. So that's after all the calculations, we have this particular figures for the total number of customers per year. Then we have income statement, which is pretty straightforward. Under revenue, we have all the revenue sources. Then we have direct costs, operating expenses, depreciation and amortization, which depends on the lifespan you entered in this particular area. So here is the lifespan you entered in here. I forgot to mention one important thing. So there's something important regarding working capital assumptions. So in working capital, what happens is we have to take care of receivables, payables, and inventory. So receivables involve the money that uh, it's the money that you that your customers that your customers have to pay you. So these are the credits to the customers, and payables is the credits we get from the suppliers. So let's say we are buying detergents and we get credit of, let's say, 30 days, then that's going to be in payables. But in receivables, since we are not selling in credit, so it should be zero. So which improves our cash flows. Just to show you, let's say if it was 7, then let's check the cash flow statement during 7. Let's check the cash balance during the second year and just compare it. 567, 356 versus, let's say, 567, 356, 0. Now let's check it out. As you can see, it has improved significantly. So if your customers don't take credit from you, obviously you will be left with more cash. But let's do the opposite. Let's say your suppliers do not offer any credit facility. Then what happens? So let's say for payables, if your suppliers don't offer you credit facility, then it's going to impact your cash flow negatively. So let's make this zero. But before that, let's first look at the cash flow statement. So it is 606. So let's make it 0. Now let's check this out. Cash flow statement 538. So as you can see, increasing the payables negatively positively impacts your cash flow, and and receivables has an opposite effect. Inventory and receivables act in a similar way. So if you have more detergents and more stocks of soft fabric softeners and other items, then obviously your cash is tied up in that inventory. So more inventory will put a burden in your cash flow. So let's make it 150, for example. Let's see what happens to the cash flow. As you can see, it has already turned negative, because if you have 150 days of inventory, as you can see, over time your business is going to be unprofitable, and your cash balance will go beyond 0, will go to negative. So as you can see, net profit has changed significantly in here. So let's change this to inventory days is like 10 days. It's again profitable. So as you can see, whatever changes you make in here is very easy. You just have to follow this three these 3 tabs, and everything else will be taken care in the back end. If you don't agree with any of the capex items in here, you can just remove them and add your own assumptions. It's totally fine, because all the suggestions provided by the AI are not going to be accurate. It is not supposed to be. It is just supposed to aid you in creating the model. So that's how the whole thing works. I think it's superbly simple the way it works, and you can also share this with your colleagues. Let's say you want to create a shareable link in here, and just share this link just like Google Sheets. You can just share this, and they will be able to look at the uneditable version of this, where they will be able to just look at these graphs and charts and the statements, financial statements. So this is how the whole thing works. Let me know if you have any questions in the comment section.